You might believe the Carolinas are still the easy answer. Lower taxes, mild winters, new subdivisions with clean sidewalks, a fresh start narrative that sells incredibly well online. You picture yourself driving down I-95, leaving a cramped northern market behind, trading stress for space, and buying the kind of home that used to feel impossible. Here's the problem. A growing number of buyers are arriving late to a story that already peaked. They're paying yesterday's prices with today's interest rates, and the math is breaking. Quietly at first, then all at once. Across pockets of North Carolina and South Carolina, the market isn't just cooling. In specific suburbs, it's doing something more dangerous. Liquidity is drying up. Homes are sitting. Price cuts are stacking. Builders are throwing incentives at buyers because they have to move inventory. And investors who helped inflate these areas are pulling back, leaving regular homeowners exposed. That's how people get trapped. Not because they bought a bad house, because they bought in a location where the next buyer is disappearing. And without the next buyer, your equity becomes theory. You can't refinance your way out. You can't wait it out if life forces you to move. And you definitely can't outsmart a payment that was barely affordable on day one. Today, we're doing a data-driven road trip through 10 suburbs where the warning lights are flashing brightest. I'm going to show you what's changing, why it matters, and what you should look for before you sign anything. And later in the video, we're going to stop near Charlotte, where inventory has started to behave like a backlog. Properties sitting long enough that sellers begin competing against each other, not the buyers. We'll also hit the coast where insurance and carrying costs are quietly scaring off the exact people who used to keep prices elevated. If you care about protecting your money, your mobility, and your future options, this matters. Hit like, subscribe, and comment. Do you think prices drop further this year, or do you think the market stabilizes? Now buckle up. We're driving straight into the shift. How to spot a trap before you buy. Before we get into the 10 locations, you need a quick framework because the market doesn't collapse in one dramatic headline. It collapses in boring numbers that most people ignore. Here are the signals that matter. 1. Inventory surge. When active listings jump 40-60% year over year, sellers start competing. That's the beginning of price pressure. 2. Days on market rising. When the median days on market doubles, the hot market narrative is over. Buyers are hesitating, and hesitation is a power shift. 3. Price cuts stacking. When 25-40% of listings cut price in a single month, it's not normal. It's sellers realizing they overshot demand. 4. Concessions becoming standard. If sellers are buying down rates, paying closing costs, and offering upgrades, the price on the listing is not the real price. It's a negotiation starting point. 5. New construction incentives. Builders can't hold inventory. When they start offering huge concessions, they drag resale values down with them. 6. Pending sales falling. This is a leading indicator. Pending sales down 15-30% means tomorrow's closings will be weaker. 7. Delinquencies and foreclosure filings rising. Even small increases can signal stress spreading through recent buyers. 8. Rental softening. If vacancy is rising and rent growth is flat or negative, investors lose their exit. That adds supply and increases pressure. Keep that framework in your head because every stop on this list matches multiple signals. Number 10, Wake Forest, North Carolina. We start just north of Raleigh in Wake Forest, the kind of town people move to when they want calm suburban life with proximity to a job market that used to feel unstoppable. On the surface, it still looks beautiful. Trees, clean neighborhoods, new construction tucked into almost every corridor. But the story underneath has changed. Wake Forest became a pandemic favorite. Remote work turned it into a magnet. Builders assumed that demand curve would keep climbing, and they planned accordingly. Now the hangover is here. Too much supply, not enough qualified demand. The key issue isn't whether Wake Forest is a good place to live. It's whether you should pay peak pricing when buyers are stepping back. Recent market tracking shows inventory is up sharply year over year, pushing into the kind of supply levels that change in negotiations. Days on market have stretched, and once days on market stretches, buyers stop rushing. Price cuts have become common enough that sellers are competing with each other, not fighting buyers. Mortgage activity in the area has softened, which matters because demand doesn't exist without financing. Here's the practical takeaway. If you're buying in Wake Forest right now, the safe play is patience and leverage. You don't reward sellers for a 2021 fantasy. You make offers based on 2025 affordability. And if the numbers don't work, you wait. Number 9, Goose Creek, South Carolina. Now we drop toward the Charleston orbit and hit Goose Creek. Historically, an affordable alternative for people who couldn't justify the historic district or the premium coastal neighborhoods. That affordable alternative pitch works until affordability disappears. Goose Creek has a classic problem. Generic, high-volume suburban inventory built for an entry-level buyer who is now priced out by rates. Developers built as if demand was endless. Now the buyer pool is shrinking, and those subdivisions don't feel scarce anymore. They feel interchangeable. The warning signs here are clear. Active inventory is up dramatically. Homes are taking longer to sell, and longer selling times create price erosion because sellers get impatient and cut. Foreclosure and distress signals have ticked upward. Investor participation has dropped, and investor pullback removes a layer of demand that used to absorb supply. Builders are pushing incentives that quietly reset pricing lower than many homeowners expected. Goose Creek is not dead, but it's exposed. If you buy here, you need margin. You need a discount that reflects risk, not a price that reflects last year's optimism. Number 8, Garner, North Carolina. Back toward the Triangle, just south of Raleigh. Garner is a perfect example of what happens when a sleepy town tries to grow into a boom market overnight. The growth happened fast, too fast. You see it in the construction traffic, the new phases, the constant expansion. But housing markets don't just need new homes. They need buyers who can qualify. And when rates are high, qualification becomes a choke point. Garner has been dealing with a heavy share of listings cutting price, inventory rising so quickly it starts to overwhelm demand, pending sales falling, which is the pipeline drying up, months of supply jumping from tight to normal to buyer leaning in a short time. Flippers and investors getting trapped because the exit price they expected isn't there anymore. This is what a correction looks like in real life. Not one dramatic crash, but a steady weakening where sellers slowly accept that the old numbers are gone. Garner's risk is simple. If you buy at the wrong price, you're the one holding the bag while everyone else renegotiates lower. Number 7, Simpsonville, South Carolina. In the upstate, Simpsonville used to be marketed as a hidden gem outside Greenville. The problem with hidden gems is that once everyone hears about them, they stop being hidden, and then supply shows up to meet the hype. Simpsonville is now dealing with saturation. Inventory has climbed for months. New construction makes up a huge portion of what's available. and builders can undercut resale homes with incentives. Only a small share of homes sell above list now, meaning the leverage has moved. Rental vacancy has started to rise, which matters because many buyers justified their purchase with "I can always rent it out." When builders are slashing prices and throwing incentives, resale owners have one disadvantage. They can't offer financing buydowns or big upgrades as easily, so they cut price. That's how comps reset. In saturated markets, the buyer's advantage is time. The seller's enemy is holding cost. Remember that. Number 6, Indian Trail, North Carolina. Now we head into the Charlotte metro orbit. Indian Trail was one of the poster children of rapid appreciation. Family friendly, accessible, and still cheaper than the city. Then the market did what markets always do. It overshot. Indian Trail pushed pricing into levels the local income base can't support without cheap financing. When financing became expensive, the ceiling cracked. Here's what you see now. Months of supply swelling fast, which is the market storing unsold inventory. Closed sales down sharply, meaning liquidity is fading. Listing prices beginning to slip, which is how negative equity starts for late buyers. Concessions becoming common, which is sellers admitting demand is weak. Investor activity dropping, removing the floor that helped hold prices up. This is the standoff phase. Sellers cling to yesterday's numbers. Buyers can't qualify, and homes sit long enough that sellers crack. If you're buying Indian Trail, the only safe way is with a deal that assumes continued softness, not a deal that assumes quick appreciation returns. Number 5, Lexington, South Carolina. Lexington sits near Columbia, anchored by schools, Lake Murray, and the idea of stabilized. But stability doesn't protect you from oversupply. Lexington has been building for years to absorb growth. When demand slows, that building pipeline becomes a liability. Here's what makes Lexington tricky. Active listings are up sharply. Days on market have stretched far beyond what sellers expect. Price reductions are widespread. Permits and new starts have begun to slow because even builders can see the shift. Expired listings are rising, which is a huge signal. It means sellers can't get their number, and instead of selling, they quit. When expired listings rise, the market becomes a pressure cooker. Those sellers often come back later with lower expectations, and that creates future waves of discounted inventory. Lexington's risk is competing with new builds, while local wage growth can't justify the peak payment structure. Number 4, Gastonia, North Carolina, west of Charlotte. Gastonia has been positioned as an affordability release valve. When Charlotte got too expensive, people spilled outward. Investors piled in. Prices rose faster than the fundamentals deserved. Now the market is stress testing the weak link. Gastonia shows classic early crack behavior. Pending sales down hard. Inventory up aggressively. Prices already slipping year over year. Days on market expanding. Investors leaving, which removes the fast exit strategy for sellers who relied on investor demand. Rent growth softening, which hurts landlords and pushes more listings onto the market. In most metros, the first areas to break are the ones that were driven by affordable relative to X, rather than strong internal demand. Gastonia fits that profile. Number 3, Mount Pleasant, South Carolina. Mount Pleasant is the kind of place people assume is immune. Affluent, beautiful, high demand, high status. And that assumption is exactly why it belongs on this list. Luxury markets don't crash the same way starter homes do. They freeze. When the carrying cost becomes too high, especially with insurance, taxes, and jumbo financing. Tightening, buyers stop moving. Sellers don't panic right away because they can afford to wait. Then listings stack. Then price reductions appear. And once price reductions start in luxury, the perception shift accelerates. What's pressuring Mount Pleasant? Luxury inventory rising, high-end sales slowing, days on market stretching toward stale listing territory. Bigger price cuts, not small ones, because the buyer pool is narrow. Insurance premiums rising and becoming a deal killer late in the process. Jumbo loan applications weakening as banks get stricter. Mount Pleasant isn't falling apart. It's becoming unaffordable relative to the payment and risk. And when the payment and risk don't make sense, even wealthy buyers step back. Number 2, Kannapolis, North Carolina. Now we hit a very specific modern risk, markets propped up by institutional money. Kannapolis saw strong investor interest during the buying frenzy. When big buyers show up, they create artificial demand and drive prices. The problem is what happens when they stop. When institutional participation drops, demand gaps open inventory, sites, comps, weaken homeowners lose leverage fast. Kannapolis is showing that pattern. Investor purchases falling sharply. Inventory rising as investor-owned homes hit the market or sit vacant. Price cuts becoming widespread. Days on market rising. Permits slowing as builders sense the shift. Distress signals ticking upward. When the biggest buyer becomes a smaller buyer or a seller, the floor becomes softer than most homeowners expect. Number 1, North Charleston, South Carolina. North Charleston tops the list because it combines multiple pressures at once: supply, affordability, investor retreat, and localized risk factors that scare off marginal buyers. During the frenzy, buyers went wherever inventory existed. North Charleston benefited from desperation. That kind of demand is not loyal. It disappears the moment options return. Now, the data is ugly. Months of supply has surged into clear buyer market territory. Prices are down year over year. Foreclosure and distress filings are elevated relative to the region. A large share of listings are sitting for long periods. Sale to list ratios are weak, meaning sellers are conceding. Investor activity has collapsed, removing liquidity. Local risk factors reduce the number of buyers willing to take a chance. North Charleston is the kind of place where value can exist if you buy correctly. But buying correctly means buying with deep margin and a long time horizon, not with hope and leverage. If you're a normal buyer trying to protect capital, this is one of the last places you want to gamble on quick recovery. We drove through 10 suburbs across the Carolinas where the story is the same, in different clothing. Supply is rising. Demand is constrained. Financing is expensive. Builders are competing aggressively. Investors are retreating. And sellers are slowly being forced to accept reality. If you're buying right now, your advantage is not excitement. Your advantage is discipline. Do not shop based on vibes and Instagram narratives. Shop based on numbers, months of supply, days on market price cuts, concessions pending sales, rental vacancy insurance, costs, investor share. If those indicators are flashing red, you don't rush. You negotiate hard, you protect your downside, and you keep the option to walk away. Now I want to hear from you. Are you seeing price cuts where you live? Are homes sitting longer? Are builders offering incentives in your area? Drop your city and what you're noticing. If this road trip helped you think more clearly, like the video, share it with anyone considering a move. and subscribe for more straight market breakdowns without the hype.